Right now, if you're over 60 and you have a checking account, there is a folder sitting inside your bank's compliance system with your name on it. It's not sinister, it's not a conspiracy, but it exists, and almost nobody has ever explained to you what's in it. Here's what I mean. Banks quietly treat older accounts differently than younger ones. Not because they're trying to hide anything from you specifically, but because the rules that shape how your account is watched, who your bank is allowed to call about your money, and what your account actually costs, you have all shifted in the last few years, and almost none of that shift was explained to customers in plain language. I'm going to walk you through 3 things that are genuinely true about banking for people over 60 right now. Not rumors, not scare tactics, the actual current rules. And by the end, you'll know exactly what to check on your own account this week. Let's get into it. Why this is happening now. Before the 3 rules, it helps to understand where they came from, because none of this happened in a vacuum. Elder financial exploitation has become one of the most closely tracked categories of financial crime in the country. The Consumer Financial Protection Bureau and the FBI's Internet Crime Complaint Center have both published data showing losses to older adults running into the billions of dollars a year. And the trend has been climbing, not falling. Family members, caregivers, romance scammers, and fraud rings targeting seniors are a documented, well-studied problem. This part isn't in dispute. In response, regulators have leaned on banks to build in more protection for older customers. FINRA, the body that regulates brokerage firms, actually made some of this mandatory for investment accounts. Banks aren't required to follow the same rules for a basic checking account, but most large banks adopted similar practices anyway, partly because it's good practice, and partly because it looks good to examiners. I want to be fair here. This isn't a story about banks scheming against seniors. It's a story about a genuine, real problem, elder fraud, producing broad policies that get applied to everyone over a certain age, whether or not they personally need that extra layer of scrutiny. For some people, that extra layer catches something dangerous before it happens. For others, it's just friction on a completely legitimate transaction. Both of those things are true at the same time, and that tension is what today's video is actually about. 2 groups are watching this. If you're on a fixed income, Social Security, a modest pension, not a lot of cushion, these rules matter because fees and restrictions hit you hardest when there's no slack in the budget. If you're a comfortable retiree with more assets, these rules still apply to you because monitoring and trusted contact policies aren't based on your balance, they're based on your birth date. Neither group gets a pass. Let's go through all 3. Rule 1. The trusted contact. The most visible change is the trusted contact request. If you've opened or renewed an account recently, you may have been asked to name someone, a family member, a friend, an attorney, that the bank can reach out to under certain circumstances. Here's the part that's usually explained well. A trusted contact has 0 authority over your account. They cannot see your balance, cannot move money, cannot make decisions for you. All they can do is receive a phone call. Here's the part that's usually explained poorly. Your bank does not need your permission in the moment to make that call. If your bank's internal monitoring flags something, an unusually large withdrawal, a wire to a new account, a pattern that doesn't match your history, and they can't reach you, or they believe you may be a victim of exploitation or experiencing diminished capacity, they can call your trusted contact directly. That conversation can happen without you being on the line. Picture someone like a retired nurse in her early 70s who receives a legitimate wire transfer, say, proceeds from selling a piece of property her late husband owned. It's a large, unusual deposit relative to her normal account activity. The bank's system flags it. A staff member tries to reach her, can't get through right away, and calls the trusted contact instead, an adult child living out of state. That child panics, calls their parent immediately, and now what should have been a routine, well-documented transaction has turned into a stressful family phone call on top of whatever estate paperwork she was already dealing with. Nothing was wrong. The system just did what it was built to do, a little clumsily. This is where I'll be honest about the split between the 2 groups I mentioned. If you're managing a smaller, fixed income, the trusted contact rule mostly works in your favor, as long as you pick that person yourself, on your own terms, rather than having your bank pick the timing for you. If you're a comfortable retiree moving larger sums, an inheritance, real estate proceeds, a big transfer between accounts, knowing this rule exists means you can get ahead of it with paperwork instead of getting caught by it. The single biggest mistake people make with this rule? Naming someone as a trusted contact without ever telling them. A trusted contact who doesn't know they've been named isn't a safeguard. They're going to panic the first time the phone rings, exactly like in that example. Tell the person you're naming. Explain what the bank can and can't tell them. That's it. What to do this week? Call or visit your bank and ask 2 questions. Do I currently have a trusted contact on file? And if so, who is it and when was it last updated? If nothing is on file, ask for the form and pick someone who won't panic, someone who understands your finances and knows in advance what that call would mean. Rule 2. Transaction monitoring. Automated transaction monitoring isn't new. Banks have used it for decades to catch fraud and money laundering. What's changed is that many banks have added specific parameters tuned to older account holders, on top of their general fraud monitoring. This isn't published on a website anywhere. It lives in internal compliance training. But its existence is well documented in industry and regulatory guidance, even if the specific thresholds a given bank uses are confidential. In practice, this can mean an account held by someone over 60 sits under a somewhat lower threshold for a human review call than the exact same transaction in a younger customer's account. Some of the behaviors that tend to trigger a closer look: a withdrawal well above your typical pattern, a wire to an account that's never received money from you before, several cash withdrawals in a short window, a sudden change in deposit patterns, or account access from an unfamiliar device paired with an out-of-pattern transaction. Picture someone like a retired teacher in his late 60s whose spouse passed away. In the months afterward, he consolidates 3 accounts, his, hers, and their joint account, into one, moving money in a handful of transfers over several weeks. He's not trying to avoid attention, he's just handling one piece of a hard process at a time while grieving. The monitoring system doesn't know any of that context. It just sees several unusual transfers in a short window, and it flags the pattern. A hold gets placed. He has to come into the branch with documentation before it releases. Nothing was wrong with the money. The process to prove that just took time he didn't want to spend. The genuine upside? If your spending is steady and predictable, you're less likely to trip these systems because your activity already matches what's expected. The real risk is a single unusual event, a large gift, an insurance payout, an inheritance, because one out-of-pattern transaction stands out more sharply against a small, steady account than it would in a larger, more varied one. If you're a wealthier retiree with more varied activity to begin with, it's often the opposite. More variation gives the software more surface area to flag something, even if nothing about it is actually wrong. Now here's the part I want to be very direct about, because I've seen people talk themselves into a bad idea trying to avoid a hold. Do not break a large transaction into smaller pieces to try to stay under the radar. That has a specific legal name, structuring, and it's covered under federal law, Title 31, Section 5324 of the U.S. Code. It is a federal offense regardless of whether the underlying money is completely legitimate. It doesn't matter that you weren't trying to evade a criminal investigation. Deliberately splitting deposits or withdrawals to dodge a reporting threshold is the crime itself, and the government can seize the funds through civil forfeiture without ever charging you with anything. You'd then have to fight to get your own legal money back. A single large, fully documented deposit generates, at most, some routine paperwork. Structuring it into pieces can generate a federal investigation. Always make the transaction in one piece. What to do this week? If you're planning a transaction that's noticeably larger than your typical activity, a rough guideline is anything over $10,000 or over $5,000 if your normal balance and activity are modest. Write a short, one-page explanation of where the money is coming from before you go to the branch. A bill of sale, a gift letter, a settlement statement, whatever applies. Hand it to the teller proactively instead of waiting to be asked. That one step turns a possible hold into a quick confirmation. Rule 3. What your checking account actually costs now. This is the one that costs people real money without them noticing, so let's get the facts exactly right, because there's a lot of misinformation floating around about this specific rule. In December 2024, the Consumer Financial Protection Bureau finalized a rule that would have capped most large banks' overdraft fees at $5, or required them to treat overdraft coverage like a loan with full lending disclosures. That rule would have taken effect in October 2025, and it sounds like exactly the kind of protective change worth knowing about. Here's the important correction. That rule never took effect. In early 2025, Congress used the Congressional Review Act to overturn it, and the president signed that repeal into law in May 2025. Not only is the $5 cap dead, but under that same law, the CFPB is now barred from issuing a similar overdraft rule again without new authority from Congress. If you've seen anything online telling you overdraft fees are federally capped at $5 right now, that information is outdated or simply wrong. It describes a rule that was written but never actually implemented. So what's actually true about overdraft fees today? The typical fee at large banks currently runs in the mid to high 20s. Recent industry surveys put the average around $26 to $27 per occurrence, with some banks charging as much as $35 to $37. A number of banks, including some larger institutions, did voluntarily lower or eliminate overdraft fees over the past few years in response to public pressure and the threat of regulation. And some of that has stuck even after the federal rule died. But it varies enormously bank to bank, and there's no nationwide cap protecting you. Some smaller community banks and credit unions charge legacy rates that are just as high as they've ever been. The part that gets missed even more often than the overdraft number itself: fee structures on the whole account have shifted, separate from overdraft fees specifically. Some banks have added new minimum balance requirements on accounts that never used to have one. Some have added monthly maintenance fees to accounts that were previously marketed as free, including some products marketed specifically to seniors. In some cases, a bank's old senior checking product has quietly been folded into a standard account with new conditions attached, communicated through a mailed disclosure that looks a lot like junk mail. Picture someone like a retired seamstress in her mid-70s who's had the same no-fee senior checking account for over a decade. No monthly fee, no minimum balance, one free overdraft transfer a month. Her bank sends a letter saying that product is being folded into a new account structure. No monthly fee as long as she keeps a certain daily balance or receives a qualifying direct deposit. Her Social Security clears that bar easily, so she assumes nothing's really changed. What she doesn't catch, buried a few pages into the disclosure, is that the free overdraft transfer is now a fee-based service, something like $10 to $12 per use. She uses it a few times over the year and pays fees on a service that used to be free, on an account she's had for years, without ever consciously agreeing to that specific change. For a lower-income retiree, the honest picture is mixed. Overdraft fees themselves aren't federally capped, but plenty of banks have voluntarily reduced them, and some genuinely good, no-fee senior products still exist. They're just not always advertised anymore. You typically have to ask for them by name. For a wealthier retiree who rarely carries a low balance, none of this may bite directly, unless overdraft protection is linked to a savings account as a convenience, in which case the terms of that convenience may have quietly changed too. The mistake people make here is assuming that because they've had the same account for years, the terms haven't moved. They have. Banks are allowed to modify account terms with notice, and that notice was very likely sent, just not in a way anyone reads carefully. What to do this week? Call your bank or check your account terms and ask two exact things. What is my current monthly maintenance fee, and exactly what do I need to do to have it waived? And what is the current fee, if any, for an overdraft protection transfer? Write both numbers down and compare them to what you were paying a year or two ago. Then ask specifically, using those words, do you have a senior checking account with no monthly fee? Some banks still have one. You often have to ask for it directly rather than finding it on the website. The two things that usually get left out. There are two related pieces almost nobody covers alongside these three rules, and they matter just as much. Trusted contact versus power of attorney. These get confused constantly, and the confusion causes real problems. A trusted contact can only be notified. They have no legal authority to do anything with your account. A power of attorney is a completely different legal document that actually authorizes a named person to act on your behalf, sometimes immediately, sometimes only if you become incapacitated, depending on how it's written. Families sometimes assume a trusted contact can step in and pay a bill, only to find out at the branch counter that the person has no legal standing to do anything at all. If you don't currently have a durable power of attorney for your finances, that's worth a separate conversation with an attorney. It's not something your bank can set up for you. Your dispute rights under Regulation E. If an unauthorized transaction hits your account, a scammer got in, a card was used without your permission, a transfer went out you never approved, federal law gives you a real right to dispute it and get your money back. But the clock matters. Report it within 2 business days of discovering it, and your liability is capped at $50. Wait longer, up to 60 days after your statement is sent, and your liability can climb to $500. Wait past that 60-day window, and you may be on the hook for the entire loss. This is exactly why it's worth glancing at your statement every month, not just for fee changes, but to catch anything unauthorized while the clock is still working in your favor. It's also worth knowing that the Senior SAFE Act, passed in 2018, gives bank employees legal protection for reporting suspected exploitation to the appropriate authorities, even without your explicit permission in the moment, as long as they've had the right training. And some states go further and allow banks to briefly delay a suspicious transaction, typically a matter of business days, specifically to give time to investigate. That delay can be annoying if the transaction turns out to be completely legitimate. It exists because, in the cases where it isn't, that short window is sometimes the only thing standing between a scam and a drained account. One more thing worth a quick check, especially if any of these 3 rules has you consolidating accounts. Standard FDIC insurance covers up to $250,000 per depositor, per bank, per ownership category. A checking and savings account at the same bank, held the same way, share that single limit. They don't each get their own $250,000. If a life event has you moving several accounts into one institution, it's worth checking whether your total balance there now exceeds that coverage, and whether something like adding a payable on death beneficiary would restore full protection. Your action checklist for this week. Let's put all of this into one simple list you can actually act on. Confirm your trusted contact. Call your bank or check your account online. If nothing's on file, request the form and name someone who understands your finances and knows they've been named. If someone's already listed, confirm it's still the right person. Review your last 90 days of transactions for anything that might read as unusual under automated monitoring. Large withdrawals, deposits from new sources, several transfers close together. For anything legitimate that could look odd out of context, gather documentation now before anyone asks for it. Verify your actual account terms. Ask your bank directly what your monthly maintenance fee is, exactly how to get it waived, and what your current overdraft protection fee is. Compare both to what you paid a year or 2 ago. Ask specifically whether a no-fee senior checking account exists. Document any large transaction before you make it. Moving more than roughly $10,000 or $5,000 if that's large relative to your normal activity from a property sale, a gift, an inheritance, or a consolidation? Write a short explanation of the source and bring it with you. Never structure a transaction. If the money is legitimate, deposit or withdraw it in one transaction with paperwork ready. Splitting it up to, quote, stay under the radar is a federal offense, full stop. Clarify trusted contact versus power of attorney with your family, and talk to an attorney separately if you don't currently have a durable power of attorney in place. Know your Regulation E timeline. 2 business days to cap your liability at $50 on an unauthorized transaction. 60 days from your statement before your liability can become unlimited. Check your FDIC coverage if you've recently consolidated accounts or received a large deposit, especially at one bank. None of this requires a lawyer, a paid advisor, or a special appointment. Every item on that list is a phone call, a short conversation at your branch, or a folder of paperwork you likely already have. Closing/CTA placeholder. For example, mention of a related free resource, membership, super thanks, external site, or lead magnet. Keep the tone consistent with the rest of the script. Practical, plain spoken, no pressure tactics. If this was useful, subscribe. I cover exactly this kind of practical, plain English breakdown of financial rules every week. Disclaimer: this video is for general educational purposes only and is not legal, tax, or financial advice. Banking rules, fees, and monitoring practices vary significantly by institution, account type, state, and individual circumstances, and they can change over time. Always confirm current terms directly with your own bank and consult a qualified attorney or financial advisor for advice specific to your situation.